Vice President of Research, John Rekenthaler, joins me now. John, welcome back to the show. It's great to have you here. I want to start by defining Vanguard's success. You wrote that it is the most dominant fund company in history. How dominant are they?
Well, Vanguard's at 19% now of total industry assets. This is mutual funds and exchange-traded funds. And previous industry leaders, there were several companies before Vanguard took over the last few years, were in the 12 to 15% range. So it's an unprecedented success, and they're going to cross 20% quite soon because they're easily the leading company in sales now.
And to be frank here, there's a reason people are flocking to them. They've lost confidence in active managers, so they're happy to invest passively and take the returns that the market gives them. I want to share with you an interview with Mr. Bogle that we had recently, in which he warned us that there might be trouble ahead in the markets in 2015. He turned out to be prescient. Listen to this.
It worries me a little bit, to be honest. We're seeing such a great year for the S&P 500. The index S&P 500 is going to look better than it will look over the long term in the future. This is a great year, but don't take it for granted, is what I would say to the index shareholders.
So he said, don't take it for granted. Of course, we have seen something of a sell-off this year. But talk to me, because when something succeeds really big in the investing world, there's always a downside. There's always a dark side. Something else always happens in reaction to that. What is going on behind the scenes because of Vanguard's incredible success?
Well, there's two sides to look at this. The one is, will the inflows damage Vanguard's ability to execute what it does? And I argue that no, it will not, which is in contrast to previous industry leaders, because they've been active managers. They get overwhelmed by putting that new money to work, and it becomes self-defeating. Vanguard, as largely a passive manager, although it also runs active funds, and a low turnover manager, is in much better position to handle volume. The other issue is, what does this...
just to interrupt here, they're getting showered with money. So as a money manager,
they're getting showered with money, but
you've got to put it to work. It's a lot of pressure.
I don't see them having any problem putting it to work. But the other question is, and this isn't just Vanguard only, because they're not the only company out there running index funds and receiving money. What happens to the stock market overall, or the markets overall, as more and more money becomes indexed? And that's an open question. And there are people who have studied this closely. I am not the one who did that. And there was a paper written a couple of years back in the Financial Analyst Journal.
To cut to the chase here, what they're saying is that you're going to have increased volatility and market fragility. Why?
That's right. Well, basically because the stocks are moving together now. The correlation between the securities has increased because indexes are more and more the buyers and sellers in the market, and they're moving together. They're buying or selling all stocks at the same time.
If you're not an indexer, and let's say you're just somebody trying to trade opportunistically, in some ways, the market's more predictable than it used to be because everybody's in a darn index fund. Is that a way to describe it?
In some ways, unfortunately, it cuts both ways, because with stocks being more highly correlated with each other, it means there's less opportunity to differentiate yourself by owning. If stocks are moving together, how do you escape aside from being in cash at the right time? So it's not clear to me that there are more opportunities for active managers, but there does seem to be more, or potentially is more volatility.
Could it hurt the overall market? I mean, why would it make the overall market more volatile? Because we all own index funds, and if we all get disappointed at the same time, we all yank our money out at the same time?
Yeah, that's part of it. Also, there's just unintended consequences when you have different trading behavior, and you do, with the market being constructed, built, and traded differently than it was several years ago. Often these things you learn after the fact, as with, for example, the flash crashes in ETFs, which people didn't see coming.
That's what I'm worried about. Some unintended consequence of this love for index funds that everybody has. I guess I'm just not the kind of person who can believe that we can all do the same thing and have it work out. John Rekenthaler, thanks for coming on. It's a tough issue to talk about, but you did a great job. Thank you.
Thank you.